It's all about the candlesticks today. Let's go. Hi everyone, my name is Barbara. You can call me the girl who trades. In today's video, we are talking about the candlesticks and how you can use candlestick patterns to trade profitably as a beginner Forex trader. Let's get into it. So in Forex trading, you commonly see people analyzing the markets using either line charts, bar charts, or candlestick charts. And we are going to talk about each one briefly. This is an example of a line chart. Line charts only show the closing price. So this is achieved by drawing a segment from the closing of one time frame to another. So if you're using a 15-minute chart, the price closed at 15 minutes, then the next 15 minutes, then the next 15 minutes. Personally, I hardly use it, but it also helps when you want to draw your trend line. It helps give a clearer view of the trend, or even when you want to delineate your support and resistance, it can come in very handy. This is a bar chart. It shows the price open and the price close, as well as the highest point price got to in a particular time frame and the lowest point. Personally, I find it a bit difficult to interpret, and it gives the same information as a candlestick anyway, so I never use it personally. Now we come to our graph of interest, the candlestick graphs. Now, this shows the price open and close as well. It shows the high and the low in a particular time frame. And really, it does give the same information as the bar chart, but I find it much easier to interpret, and really it is more visually appealing, so it's easier for me. So we'll go on straight into talking more about the candlesticks. The anatomy of the candlestick. Now, candlesticks apply to all time frames. So you can have a candlestick in the 1 minute, 5, 15, 1 hour, 1 month, 1 week. Every time frame you can apply a candlestick to. Now, most trading platforms will use white to refer to bullish candles, and then black to refer to bearish candles. Personally, I like using green for bullish and red for bearish. You can choose whichever color you want. It doesn't really matter. Now, the anatomy is that where price opens, if price opens at a particular point and then closes at a higher price point than it opened, then we have a bullish candle. And as we can see in the image here, bullish candles represent an increase in price over time. In the same way, for a bearish candle, price opens at a point and closes below the point where it opened, and that is what a bearish candle is. Now, the thin lines you see above and below, they are called the shadows or the wicks, and that represent the highest point a price got to, and then the lowest point a price got to. And then the solid bit in the middle, the solid red or green portions, are what we call the body. So candlestick patterns are the language of the market, and they can tell you so much if you're able to interpret them. However, I do not recommend that you trade just with candlestick patterns. Usually I use them in confluence with other technicals to actually understand what price action is going on and to refine my entries into my trades. The first candlestick pattern we are going to talk about is the engulfing candlesticks, and that happens when a bearish candle is engulfed fully by a bullish one, or a bullish candle is engulfed fully by a bearish candle. Now, on the left, we have a bullish engulfing candlestick pattern, and if this occurs at the bottom of a downtrend, maybe as a support, if this happens, it means that the bulls have overtaken the bears, and so a trend reversal is very likely going to occur, and so you can enter in for a buy to go long. On the right, we have a bearish engulfing candlestick pattern. Again, this comes in very handy if you are at the top of an uptrend you've hit a strong resistance point. If you see this pattern, it is possible that there's going to be a trend reversal because the bears have come in strongly and have pushed price down. So you can enter in for a short and also make some money. Here on the chart, if you look to the far left, you can see an example of a bullish engulfing candle. So the black line represents a support, and you can see that support was respected later on the right. But this black line is representing a support. So the price was in a downtrend. It hit the support, and then the bulls come in strongly. And so you see the bullish candle engulfing completely the previous bearish candle, and then price continued to push upward. The next candlestick pattern we are going to talk about is the Doji candle, and that's one of the most important candlestick patterns. When this forms, it tells us that the market opened and closed around the same price, which means that there's indecision between the buyers and the sellers, and so nobody is in control of the market. This is important because that means buyers couldn't push the price further up, and the sellers also couldn't take over completely to push price down. If this trend occurs at an uptrend or the top of an uptrend or at the bottom of a downtrend, it indicates that market is likely going to reverse because it means that the prior trend is losing its strength. So if it was an uptrend, it means that the buyers are losing strength, and if it's a downtrend, it means that the sellers are losing their strength. So here in this image, we have an example of a doji candle, and this formed at the bottom of a downtrend. The black line represents a support. Now you see that price was moving downwards with quite some momentum, but as soon as the doji candle formed, it means that the sellers could no longer push price any lower, and so the buyers came in. There was a strong engulfing candle, and then price continued upward. Another important thing to learn about doji candlesticks is that if you're in this trade, for instance, for a sell, and price reached the support level and a doji forms, it's likely a reversal is going to happen, and so it is a good point to take profit. The next candlestick pattern we're going to talk about is the tweezers. Now we have tweezers tops and tweezers bottoms. The tweezers tops is usually a bullish candle that is followed by a bearish candle, and then the tweezers bottoms is a bearish candle that is followed by a bullish candle. They are usually of the same body size, about the same body size. And if you see tweezers tops at the top of an uptrend, it is usually a sign of a bearish reversal. And if you see the tweezers bottom at the bottom of a downtrend, it is also a sign of a bullish reversal. What happens is that you see this candlestick with a thick body, which means that if maybe at the top of a trend, you see that the bulls are in control with a big body, and then the bears come in with another strong candle, almost the same size as the last candle, meaning that they've overtaken the bulls as they came in, and that usually would continue with that momentum and ride it downwards. So in this example, you see a tweezers bottom at a strong support level represented by the black line. So you see the bears came in, hit the support level, and then the bulls came in very strongly with about the same momentum as the previous candle, and then continued to push price upward. So the last candlestick patterns I'm going to talk about are the morning star and evening star patterns, which are both considered reversal patterns. The morning star pattern is considered as a bullish reversal pattern and would be of best use to us if it occurs at the bottom of a downtrend. Now it consists of 3 candlesticks. The first will be a bearish candle, which will tell us that the sellers are in charge. Then it's followed by a small second candle, and that may be a bearish candle, but it's a small one, meaning that the sellers are losing control. Then the next one will be a strong bullish candle, which will close more than half point of the first bearish candle, which means now the bulls are now taking over. So it is a strong reversal pattern if you find it at the bottom of a downtrend, potentially at a strong support level. The evening star pattern is just the opposite. So that's a bearish reversal pattern, and it's most useful to us if it occurs at the top of an uptrend. So it also consists of 3 candlesticks. The first is a strong bullish candle. The second is a small candle, maybe bullish or bearish, or it can even be a doji. And then the third one is a large bearish candle, which will indicate that the bears have now taken over from the bulls, and so a reversal is going to occur. So in this image here, we have an example of a morning star. This isn't a very perfect example because the small candlestick we have there, this can also be called a hammer. We are not talking about hammers today, but yes, so you have a bearish candle, then we have the hammer, or the next one being a bearish candle with a very small body, and then a strong bullish candle continuing, and then you see that the trend continues upward. So that is a perfect example of a morning star. So you guys, this is by no means exhaustive. This isn't all the patterns that are out there, but these are my favorite to trade, and so I wanted to share them with you. Thank you so much for watching today's video. I hope you enjoyed it. Let me know in the comment section if you like this style of videos. Please also let me know if there are any videos you want me to film, and I will get to them. Please do follow me on Instagram, The Girl Who Trades, and on TikTok, The Girl Who Trades GH. Disclaimer, I'm not on Twitter. I don't have a Facebook page, and I don't have a Telegram Signal channel. I won't ask you to send me money. Please don't send your money to any scammers. Thank you guys so much for watching the video. Do subscribe, like the video, and share with your friends as well. So till next time, it's The Girl Who Trades.